Hi and welcome to another session of accountancy with me Vishwanath sir for the 12th standard. We last were doing accounting ratios and we finished with the limitations of accounting ratios or ratio analysis. Now let us come to the classification of the different types of accounting ratios. From there we'll pick up each ratio and understand its significance and understand how to do it. Okay, your ratios are classified into liquidity ratio, solvency ratio, activity ratio and finally profitability ratio. Your liquidity ratio, which we shall be doing first, will be comprising of two important ratios, which is your current ratio and your quick ratio. Okay. And then we shall go to solvency ratios, where there are four types of ratios: the debt equity ratio, the total assets to total debt, the proprietary ratio and the interest coverage ratio. Then we have got the activity turnover ratio, which has got the inventory turnover ratio, the trade receivables turnover ratio, the trade payables turnover ratio, the working capital ratio. And in profitability ratio, you've got gross profit ratio, operating ratio, operating profit ratio, net profit ratio and return on investments. Okay, so this is where we are going to be there. Fine. So let us go to this term, the first liquidity ratio, which is your current ratio. Okay, your current ratio formula is current assets upon current liabilities. Okay, what is your current ratio? It is current assets upon current liabilities. The ideal current ratio is 2:1. That means you have got 2 rupees to pay off your 1 rupee. Okay, so basically this is going to be the ideal current ratio which is there. Okay, let us take up one example here. There is sundry debtors, which is 1 lakh. There is prepaid expenses, which is 10,000. There is cash and cash equivalent, which is 30,000. There are short-term investments, which is 20,000. There is machinery, which is 7,000. Bills payable 20,000. Sundry creditors 40,000. Debentures 2 lakhs. Inventory is 40,000 and expenses payable 40,000. And in this, they are telling us to calculate the current ratio. Okay. First of all, we need to understand what are the current assets. Your current assets in this sum is your sundry debtors, which is 1 lakh, prepaid expenses, which is 10,000, cash and cash equivalent, which is 30,000. So 1 lakh plus 10 plus 30, 1 lakh 40. Then you have got your short-term investments, which is 20,000. So that gives you 1 lakh 60. And you have got your inventories, which is 40,000. So 1 lakh 60 plus 40 will give you 2 lakhs. Okay, so it's 1 lakh, 10,000, 30,000, 20,000 and 40,000. Okay, so that is 2 lakhs. Let us check your current liabilities. It is bills payable 20,000, sundry creditors 40,000 and your expense payable, which is also 40,000. So if you add that 20,000, 40,000 and 40,000, it will give you 1 lakh. Your current assets is 2 lakhs and your current liabilities is 1 lakh. So 2 lakhs divided by 1 lakh will give you 2:1. Okay. So this will be your current ratio. Your current ratio is a good ratio in this particular sum. It is 2:1, which is also the ideal ratio. Okay. Now let us check out one more example. Your total assets, the figure of your total assets is 3 lakhs. The total of your fixed assets is 1 lakh 60. Okay. Is 1 lakh 60. Your shareholders funds is 2 lakhs. Your non-current liabilities is 80,000 and your non-current investment is 1 lakh. Now let us understand that your total assets is 3 lakhs. That means your total liabilities is also 3 lakhs. So here your fixed assets out of that 3 lakh is 1 lakh 60 and your non-current investment is 1 lakh. So 1 lakh 60 and 1 lakh will give you 2 lakh 60, which means 3 lakhs if you minus from 2 lakh 60, it will give you 40,000. So 40,000 is your current assets, while as your shareholders funds is 2 lakhs and your non-current liabilities is 80,000. Okay, so it is 2 lakhs upon 2 lakhs plus 80,000, which is 2 lakh 80. So your current liability is 3 lakhs minus 2 lakhs 80, which is 20,000. Your current assets is 40,000. Your current liabilities is 20,000. So the ratio is 2:1, which is again an ideal ratio. Okay. Now you have got to remember one more thing, that your working capital is equal to current assets minus current liabilities. Okay. Fine. Now we take up one more example because we have introduced the word working capital. Your current assets is 4 lakhs. Your inventories is 2 lakhs. Okay, inventories is a part of current assets only. Your working capital is 2,40,000. Find the current ratio. Now in this sum we need to find out the current liability. If we do not find the current liability, we will not be able to find out anything. We will not be able to find out the current ratio. Okay, the current assets is 4 lakhs. The current assets is 4 lakhs. The inventories is 2 lakhs. So inventories is of no use, it is just misleading. Your working capital is 2,40,000. Working capital is equal to current assets minus current liabilities. So working capital you put 2,40,000, you put your current assets as 4 lakhs and minus your current liability. Send your working capital on the left hand side, which will give you current liability is equal to current assets minus working capital, that is 4 lakhs minus 2,40,000, which is 1,60,000. So your current ratio is equal to 4 lakhs divided by 1,60,000, which is 2.5:1. Okay, which is 2.5:1. Finally, let's come to one more example. In this one more example, your current assets are 5,25,000. Your inventories, that is including your loose tools, is 75,000. Your working capital is 2,25,000. So first, let us understand that your current liabilities is 5,25,000 minus 2,25,000, which is 3 lakhs. Okay, and the loose tools you have to remove it from the current assets. The loose tools are supposed to be removed from the current assets. So your current assets will become 4,50,000. From 5,25,000 you are going to minus 75,000. Okay, you are going to minus 75,000. So your current assets becomes 4,50,000. Your current liabilities is 3 lakhs. So the ratio is 1.5:1. Okay, I end this session with this particular sum. Okay, we will meet in the next session with more sums to come. Thank you so much. This is Vishwanath sir signing off.